The second video on chapter 2 is about equity as an asset class. Before we talk about that, I wanted to flip back to the last video. We talked about fixed income and show you this graphic that's in the slide deck so that you can see just how important the federal government is and government entities to our economy, what a large component they play. You can see that Treasury debt, that's Treasury bills, notes, and bonds, are almost 14 trillion, $13.9 billion, trillion, 13.9 trillion. And then you have federal agency debt, and if you look at the left side, 3.8 trillion in tax exempt. That would be municipal issues, government issues. And the mortgage related debt is largely Fannie Mae and Freddie Mac. So much of the debt, and the debt markets are larger than stock markets in the United States. So much of the fixed income debt market here is related to the federal government. So now we're going to move along to looking at equity as an asset class. We've already looked at fixed income. So we'll look at some of the security types that make up equities and just some general learn this space around equity. So first of all, we've got something called American Depository Receipts. They are traded in the United States on American exchanges. And all they are they represent shares in companies that trade on other exchanges outside of the United States. So there may be a company that trades on the Singapore exchange, and then ADRs trade in America on that company as well. So that's all ADRs really are. And then we've got the primary corporate securities in America, common stock and preferred stock. You probably are aware that the common shareholders get whatever is left after, in the event of a bankruptcy. That's called a residual claim on the assets of the company after all other claim holders or stakeholders are made whole, like lenders, bondholders, preferred shareholders. In the event of a bankruptcy, when those groups are made whole, then whatever's left would go to the common stockholders, because these really are the owners of the company. So just as if you owned a small business in Tallahassee, a car wash, if you went bankrupt, everyone else gets paid before you get anything. And it's the same with in the corporate world. So an advantage to common shares is you have very limited liability. So essentially none in a publicly traded company. So that's an advantage of common stock. Now, an advantage of preferred stock is you get fixed incomes. Investors get fixed income or dividends. However, preferred shareholders don't get to vote on corporate issues, while common shareholders, they're true owners of the company, they do get to vote. So that's a big difference there. Like I mentioned, preferred shareholders have a priority over common shareholders in the event of a bankruptcy or liquidation. There's also an interesting little twist here that corporations get a tax exclusion for preferred dividends for 70% of the preferred dividends that come into a corporation. So if one corporation owns preferred shares in another company or corporation, they get preferred tax treatment here. So that's an advantage for corporations to own preferred shares, and for that reason, most of the preferred shares in circulation are owned by corporations because they get favorable tax treatment. You've learned how to calculate total return, dividend yield, and capital gains yield in other finance classes, but I'll touch it again just to refresh your memory here. This is an example that if an investor were to buy a stock for $50 hold it for a year, collect $1 in dividend, sell the stock for $54. This is how you calculate those returns. First of all, the dividend yield here is very easy because you earned $1 and you paid 50. So 1 divided by 50 is 2%. That would be your dividend yield. Very easy. The capital gain yield is simply first of all, your capital gain is how much you earned on the stock. So in this case, we sold it for $54, paid $50 for it. So we earned $4, right? So here you go right here, 54 minus 50 is 4. You divide it by the price you paid for the share. And so $4 divided by 50 would give you an 8% capital gain yield. You can add the dividend yield plus the capital gain yield to get the total return is the simplest way to do that. Or you can just add your capital gain here plus your dividend and then divide by the price you paid. So either way will get you there. So that's something you should know how to do and be aware of here. When you look at stocks, whether finance.yahoo or Google Finance or wherever you like to look at that, maybe you still get a newspaper or the Wall Street Journal. At any rate, most investors, first of all, you should know that companies trade by a symbol. So this company, General Electric down here, their symbol is GE. It's kind of shorthand for the company. Let's take GameStop here. They closed at $23.57. The change from the previous day, the number of shares that traded hands here. And then this publisher, this is from the Wall Street Journal Online. You've got the 52-week high and the 52-week low. So we can see GameStop is closed at $23.57, near their 52-week low. So something's happened here that's pushed them down. Here's the part I really want to get to is you should look any company you're looking at to see if they pay a dividend. And this company, GameStop, pays a $1.52 dividend, which equates to a yield of 6.45%, very strong yield. This is the PE ratio, or price to earnings, and it's simply price per share divided by earnings per share is a 6.87%, or it's also mentioned as a multiple, the price earnings multiple. So we're paying 6.87 times the earnings for this stock. And then we have the change year to date from January 1. Some sources also quote the change for the past year, but this one is year to date. So we're going to talk a minute about stock and bond market indexes. Indexes are useful for several reasons. First of all, we can see how a particular space is tracking or averaging. For instance, there's an index for technology, and we can see how the technology sector is doing, right? Consumer durables or whatever sector of the economy, there's indexes constructed for all of these. And so if you're considering investing in a mutual fund that does technology, you might want to compare that fund's performance versus a technology index, so that you can compare the performance of that fund or that manager of the fund to see if you think he's doing a good job. They're also used in basing derivatives on an index. So indexes vary. They're constructed in different ways. Some are narrow, like I mentioned in technology. Some are very broad to cover the entire stock market. So we're going to look a little bit more at indexes. So one thing to be aware of with indexes is how the indexes are constructed, how a particular index is constructed, because there's different ways to build them. The first is a price weighted, is to take an index, build an index by taking a number of stocks and averaging the prices of the securities within that. So an example of this is the Dow Jones Industrial Average. So the Dow Jones is an average of 30 stocks. And originally, the Dow Jones was constructed by adding the prices of those 30 companies together and averaging them. However, it's been changed a lot over the year, and because of for various reasons, stock splits, dividends, and as one company would be dropped from the index and another one added, so that now the Dow Jones is over 25,000, which is not an average of the prices. So it's become kind of convoluted. But price weighted essentially means adding up the companies in index and divided by the number of companies. Another approach is market value weighted. Now, market value, first of all, means market capitalization, and you'd get the market cap of a company by taking all the shares in that company is issued and multiplying by share price. That would tell you their market cap or market value. So the S&P 500 takes 500 companies and weights the price of each based on how large the company is per its market value. So a company that's $100,000 market value would get 10 times the weighting as one that's 10,000. So it just gives more weight to larger companies using this approach. And then an equally weighted index takes the opposite approach. It says we don't care about market cap. We're just going to take 100 companies and add up all of the share prices and divide by 100 to get a simple average of the prices. This slide gives you indexes, lists some indexes that use the different type of weighting schemes, like I just mentioned. The Dow Jones Industrial is price weighted, S&P and NASDAQ are market value weighted, and so forth. Now we're going to move to the derivatives market, our third asset class, derivatives. So a derivative is an asset whose price is contingent on another asset, or it depends on that. So it's along the lines of saying, look, if the price of IBM stock goes up 10%, then this security I'm creating is also going to go up. It's going to go up 20%. So you'd have a leveraged derivative there. But the two basic derivatives that are common is a call and a put. And a call gives the buyer of that call option. This is at the option of the holder of a call. They have the right to buy an asset. The right, but not an obligation. They don't have to buy it, but they can buy it at their option at a particular price up to a particular date. So it is a call, is a right to buy, an option to buy. Well, then we also have an option to sell. Now, you may not own Apple stock, but you can buy the option to sell it, even though you don't own it, okay? So, and that's called a put option. So it's a right to sell an asset at a particular price, called the exercise price, on or before a particular expiration date. So those are calls and puts, and you should try to get these two basic ideas in your mind. Those are the fundamental derivatives, and there's a lot of others that are built around those, but you should be familiar with those two. So here's a list of some, well, in fact, on Apple, some calls and puts are listed, and this brings up another term in stock options called the strike price. So at let's say May 12, an option that would expire May 12 of 2017, of course this is a little dated, an investor, per this listing that came from NASDAQ, could buy a call, which is an option to buy Apple stock. You could buy that option for $3.80. You buy the right to buy the actual shares at $140. If you could buy that option today, you'd be able to be instantly what's called in the money. So you could at this point, an investor could also buy an option to sell Apple stock for $2.71. That was the price of the option. Before I leave this slide, notice over here that Apple was trading for $141.20 on the date that these option prices were published. So you can see that some of these strike prices are below. You'd have an option to buy the stock, Apple stock, for less than it's actually trading at. Okay, so we're going to move to the next slide and set up a problem around that. So a call option on Apple stock. So first of all, the contract size on options are 100 shares. So if you buy one call, that's an option to buy 100 shares, not just one. So that first call option was to buy at a strike price, like I pointed out, of $135, and with a May expiration. So the cost would be 100 shares times $1.63 per share. That call would cost an investor $763. So the first question is that contract in the money? Well, you'll recall that Apple is trading for $141. You can buy that call option for $135, so it is already a profitable position, and that's called in the money. So an option that is not in the money is called out of the money, and is also a term at the money, if it's right at being in the money, right on that balance point. So when should you buy this contract? Well, any call option would be bought when you think the price of the underlying shares are going to go up. So in this case, we have a call on Apple with a strike price of $135. We have the option to buy it at $135 up until it expires in May. So we hope that the price goes to $1,000 because we have the right to buy it for $135. If we thought the price was going to go down, we would prefer to buy a put, an option to sell at $135. We'd hope it goes down to $10, because then later we could buy at $10. That's called covering. We would cover at $10 and sell at $135 and make $125 if it were a put. So in this case, let's say it goes from $135 to $165. It goes up $30. Our put option is worth in the neighborhood of $30. It's more technical than that, but we'll get into this more in the last section. So now you can also, besides buying a call, you can write one. And if you write it, you're selling someone else the right to buy essentially from you. So in that case, you would write a call if you thought the price was going to stay the same or go down. I encourage you to use Investopedia, the internet, and learn more about calls and puts. It's a fascinating area and something I'm very interested in myself. So now we're going to look at a put option on Apple. McGraw-Hill had a little slip up here. A put is an option to sell, not an option to buy. Somebody copy and pasted from the last slide, apparently at McGraw-Hill. Not my fault. At any rate, so a put is the right to sell 100 shares. In this case, we arbitrarily picked a strike price of $135. That's a strike or exercise price. So that's a key term. You need to be familiar with the term strike or exercise. With expiration date, what that is, you need to know what in the money, out of the money, at the money means, those terms. So similar math, the cost per share is $1.17 times 100, $117 for this put contract. and I believe Apple was trading a couple slides ago at 141. So why would we be interested in selling it for $135 with a put contract if we could sell it for 141 in the open marketplace, right? So this contract has very little value. The value it has is up until expiration. If Apple falls below $135, then this contract has intrinsic value. It becomes in the money anytime Apple shares go below $135. You've also got the cost of this contract to take into account, but aside from that, if Apple goes below 135, this contract has value. So our third asset class we've been studying is derivatives. That includes options, and we've covered puts and calls under options. And the second major, in addition to options, the second major area under derivatives is called futures. So you've probably heard of futures contracts. And a primary difference here between futures and options, you'll recall that I mentioned options provides the option but not the obligation to execute on the contract. So an investor has the option to buy with a call. A call provides the option but not the obligation to buy Apple shares in the future. A futures contract creates the obligation. In fact, it's said that the purchaser buys, when you buy a futures contract, you have bought it to be executed at some future time. So you're committed to buying that. And when you buy a futures contract, you're said to be long. And if you sell a contract, a futures contract, you are short. And they mostly futures apply, are most prevalent in commodities like the grains, oil, those sorts of things, as well as currencies. So you can buy or sell a futures contract on Japanese yen, euro, that sort of thing, most major currencies in the world. There's futures markets for them. So futures also have a contract expiration, and on expiration date, your purchaser that's long a futures contract on yen is obligated to then buy those yen. We'll conclude this video with some just terminology you need to be familiar with. We talked about calls and puts, and under options, you need to know what the exercise or strike price is, what the expiration date is about. I'm going to add on here the term the premium. So the premium is the cost of the option contract. How do you spell premium? I think it's IUM, isn't it? Premium. So we need to be familiar with those terms. Also, in the money, at the money, out of the money. Basic terms. With futures, you need to know what long and short means. The delivery date. And what the deliverable item. Is it corn, crude oil? What is it? So futures contracts have a delivery date. Options have an expiration date. So we're going to stop here with this video and pick up next time. And in the meantime, I want to encourage you to spend less than you earn. Save some money, invest it, and store up enough wealth that you'll be able to retire someday. See you next time.